Hello, everybody, and welcome. Today, I will be doing an analysis of the Hershey Company stock, ticker HSY. Right now, we're in a stock market of some pretty absurd valuations, not necessarily unjustified, but for value investors out there that are interested in finding a deal, it doesn't look like there's a whole lot out there. If that fits your profile as an investor, particularly as a dividend investor, then this company here has likely hit your radar. So, just full disclosure, I do have a position in this stock. I have a fairly significant position in this stock that I've built over the last several months for the first time. And I'm compelled by the value that it presents in this market right now, and see it as somewhat of a contrarian bet. And today I'm going to be diving into, the reasons why it may or may not be a compelling investment for your portfolio. So let's go ahead and get started. First, we'll go into the overview of the company. So Hershey's is the number one confectionery company in the United States. And in 2023, they had 11.2 billion in sales. And if that sounds like a lot, well, it really isn't compared to some of its competitors, namely Mars and to a lesser extent Pepsi. But given its leading market position with brands such as Hershey's bars, Reese's peanut butter cups, Almond Joys, Mounds, the rights to Cadbury in the United States, Heath, Hershey's Kisses, Icebreakers, Jolly Ranchers, Kit Kats, so on and so forth. In addition to the recent expansion of what they call the salty snack portfolio, with brands such as Pirate's Booty, Skinny Pop, and I believe that is really the gist of their salty snack portfolio. Anyways, given this portfolio of brands, it's easy to see why Morningstar has assigned a wide economic moat score to this stock. So, as for the thesis of why this stock looks like a compelling investment now, there's a couple different elements of that. But any investment in the stock market is primarily compelling to me if it has a wide moat. So that box really needs to be checked off at the onset. And to me, a moat means pricing power. And pricing power is important from the standpoint of being able to maintain consistently high gross margins, especially in an inflationary environment. And that's what Hershey has done historically. It's been able to drive very high, consistent returns on invested capital and returns on equity. So, as for the stock itself, another one of the reasons that this does look particularly compelling is the price chart. In fact, why don't we chart this opposite the S&P 500 at large? What you see here is interesting in that this stock, at least over the last 5 years, tends to underperform the broader market in a bull expansion. And in the most recent bear market that we experienced, starting in 2022, this stock significantly outperformed. And that makes sense because the economic shock that drove the sell off of the broader market at large was an inflationary shock. Companies like Hershey that sell packaged food products tend to outperform in inflationary environments if they have pricing power, given that they can, price their products in a rate that offsets the commodity inflation and continue to drive sales growth. Now, It doesn't take a rocket scientist to see that, starting in the second quarter of last year, this stock really has drastically underperformed the broader market at large, and that's extended into this year as well. And there's a couple reasons for that. They're all narrative driven, of course. We know that the stock market is primarily driven by sentiment and narrative, and to a lesser extent fundamentals. And I think as our job as good investors is to spot mispricing opportunities that are driven by narratives, where fundamentals are still good. This stock is kind of a murky picture of that. But if we go into the narratives that are driving the sentiment of this stock very negatively, it's twofold. One being the onset of GLP-1 weight loss drugs like Ozempic, the onset of very high sales growth once those drugs hit the market. It really caused a lot of companies like Hershey to significantly underperform the broader market. In fact, just to kind of give you an idea, I can pull up a couple of stocks that are in a similar vein: General Mills and PepsiCo. We'll just take a look at these. We see that the price action on General Mills and Pepsi stock is pretty similar to Hershey. In other words, they both outperformed the broader market during the bear market and have deeply underperformed since. So there's a lot of sentiment in the market right now about the impact, the true long-term impact of weight loss drugs that supposedly cause users to consume less junk foods and packaged food products, highly processed food products. So that was kind of the beginning of what started to mark these stock price declines across this sector. But one thing that's been impacting Hershey more so than these other companies is the cocoa price. And in fact, why don't we pull that up? Okay, so here is the cocoa price per ton in dollars. We see here, we'll pull it back as far as we can. The cocoa price, like many commodities, has tended to trade up in dollar denominated terms over time, as many commodities have. You see here pricing relatively stable throughout the 60s, and at $400 to $600 a ton. And during the mid to late 70s, there was a significant shock that drove the prices up about twofold, and well, actually fourfold. Since then, prices had hovered around the from anywhere from $1,000 a ton up to 4,000. But the most recent bout of inflation really spiked the cocoa price, really to levels, unprecedented levels that had never been seen. That being said, this price shock here, fairly similar to what was seen in the early 70s. Hershey's been around since the late 1800s, and has really done well across the entire time frame. But it doesn't take a genius to see that the cocoa price being a major input to Hershey's production process and therefore their gross margins, the significant expansion of the pricing of that commodity has really driven a lot of negative sentiment in the stock price. In fact, you see here July, September 2022, $2,200 a ton. And by April, May 2024 is when it kind of hit the peak. And so we see here prices were relatively at their low point right here. Let's remove these other symbols here, and really reach their zenith around this part here. So it's fairly simple to understand why there's a lot of negativity around this stock from a narrative and sentiment perspective. But has the sell-off made this stock a value price? Has it made it a good, compelling valuation for us to dip into? I certainly think so, but there are some asterisks there, which we'll explore now. So if we look at it from a valuation standpoint, historically, then we can see that if we just look at the price earnings gap on a retroactive looking basis, that the stock right now is trading at the lower end of its historical range within the last 25 years or so, and that is somewhat of an anomaly in this market. In fact, what we've seen over the last few decades is multiple expansion driving a significant amount of the returns in the overall broader market. In fact, I'll just select another stock that I love, Costco, to demonstrate what I'm talking about here. So you see here, Costco stock really in the last 15 years has seen an elevated and elevated and elevated price earnings multiple, and is really trading at an all-time high valuation on earnings. So the Hershey stock is somewhat of a anomaly in today's market in that its valuation multiple is extremely compressed and depressed compared to a lot of other stocks in the market. It doesn't necessarily mean that it's a value. If we look at the valuation in terms of its dividend yield, we see again trading at a 10-year high in terms of dividend yield. So both on a cash flow basis and price earnings multiple basis, we are seeing a price right now that looks like a value. However, this stock isn't exactly cheap. And the reason for that being is that its earnings growth has really stagnated. In fact, the price earnings growth ratio, in fact, if we were to compare this with the first stock that comes to mind, NVIDIA, of course, NVIDIA has been a strong outperformer the last really several years against the broader market. And on a risk adjusted basis, its returns have been far superior to Hershey. But we see here the price earnings growth ratio of NVIDIA is 1.14, which is pretty exceptional, actually. Anything less than 2 is, fairly priced on an earnings growth basis. So in terms of the valuation of Hershey stock, I would say that it is fair. In other words, you buy it at today's price. It is the lowest valuation that you've had the opportunity to purchase it in a while, especially in terms of yield. However, the stagnating earnings are really what's driving that in addition to the sentiment. So if you do enter this stock, it would be fair to probably not expect it to outperform, at least over the next few quarters. If we take a look at their financials here, we do see slow and steady revenue growth, single digits. These last few quarters there have been somewhat of a trailing dip off in revenues, and what this implies is that there's more at work here than just the narrative, just the commodity price. Again, the commodity cocoa price being elevated versus history, that should not really impact revenues. It should impact profits. The fact that we're seeing revenues trail off from the prior year in the last few quarters, there's something else at play here. It could be possible that they've raised prices too much and therefore are seeing stagnating or declining market share versus their main competitor, Mars. So that's definitely a concern if you're an investor. Is it's one thing to see the sentiment be driving the price down, but fundamentally the stock is in a place of weakness right now. And that really brings us to the risks of this particular stock. The first should be probably the most obvious. It's that the cocoa price remains elevated longer than perhaps you might anticipate. I'm kind of a reversion to the mean thinker. My belief is that the commodity price will come down. However, that's not something that I can control and not something that I have a huge pulse on. So it is possible that the commodity price remains elevated. And in fact, Hershey, like their competitors, Mondelez, Mars, they purchase a lot of the product using the futures market, which allows them to hedge their costs lower. So in a recent report, they did say that the majority of their input costs right now is in the $2,000 to $5,000 a ton range for cocoa, and that will exist for the next couple quarters. So that's interesting, right? Because what we're seeing is that the commodity price having an eight handle on it isn't even really hitting the bottom line yet. It's mainly driving the sentiment. So that's definitely a risk. If the cocoa price remains elevated for 5 years, all of their futures contracts roll, they enter into new forward purchasing agreements at the elevated prices. That will depress margins further, and it certainly won't help the sentiment around the stock. However, the flip side of that is if you believe, like I do, that it's a good, stable investment for the long term, it will mean that really over that 5 year period, if that does happen, it will continue to be a compelling investment to accumulate with a 20 to 30 year time horizon. Another risk with this stock is also the reason that narrative and sentiment is low. We don't fully understand the impact of the GLP-1 drugs. It could be that what we're seeing in these financials is driven by these GLP-1 drugs. Again, we're seeing kind of a stagnation of revenue growth over the last few quarters. It could be attributable to that. We're not sure. And last but not least, the final risk factor that I would like to highlight here is the recent election. Donald Trump, he appointed or plans to appoint Robert F. Kennedy Jr. to the FDA or what the Food and Safety Administration or whatever it is. Anyways, there's been a lot of negative sentiment the last really few days since that was announced. This is November 18th when I'm recording this. It was a few days ago this was announced. He did say that he wanted to enforce that American companies really cut down on a lot of the artificial ingredients that they have in their products. And Hershey's would be included in that list, given that they're, along with sugar in their chocolate, they're also putting corn syrup, they're also putting preservatives and stuff like that. So, will that impact their brand positively if they make those changes to more health conscious consumers? I do believe that there is a positive from that. However, that could also weigh on margins. So we are in an environment with this stock where we do see uh, an environment moving forward that it may trade sideways longer than you might anticipate if you are looking to make an entry point. So now we'll come to, is this stock a buy? Is it a hold? Is it a sell? I really think that it depends on your strategy. My strategy as an investor in a taxable account primarily is yield. I like income. I think that this stock has safe dividends that have grown quickly in the last 5 years. I do not believe they will grow nearly as fast the next 5 years, but a normalization of their input costs will lead to a normalization of dividend growth. And the fact that it's trading at a 10-year high yield wise makes it a compelling investment for my strategy. Also, the fact that it has outperformed in periods of broader market weakness also makes it a buy for me. I've already over allocated to this stock. I have roughly 6.5% of my portfolio in this stock. If it continued to drop further, I might consider adding more. However, I do not expect this stock to beat the market. I do expect it to have good risk adjusted returns over the next 5 years. However, it has, clearly not been the case the last year or so. If your strategy is to market perform or market outperform over the next 5 years, then it's probably a hold if you already have it. If your strategy is momentum trading, then you should sell it and you should buy something that is trading with phenomenal sentiment right now, like Hims and Hers or Palantir or Nvidia, the market darlings out there today. So yeah, I like stocks that will give me a good chance of outperforming the broader market in a bear market. And given that we're in what I believe to be the latter stages of a broad-based bull market, I think that it is a compelling buy and has a place in a portfolio that's maximizing risk-adjusted returns. So if you were to buy the stock, then what other positions could you enter into to hedge a little bit? In other words, what are some good risk parity trades to enter into with it? Given that the GLP-1 drugs are driving a lot of negative sentiment, I would expect that the drug makers of the GLP-1 drugs might be a good risk parity trade. And there's two tickers that come to mind. Novo Nordisk, which is the creator of Ozempic. And mainly what I'm looking for here is the correlation. So we see here the correlation between Hershey and Novo Nordisk is 0.15, which is fairly low. Novo Nordisk is also quick growing again due to the GLP-1 drugs and trading at a fair price earnings growth ratio. So if you are heavily allocated to Hershey or plan to be, then it might make sense to pick up a little bit of kind of the opposing trade there and hedge your bets a little bit. In fact, we see over the last 3 years that stock has really performed well. So we see here during this period where Hershey starts to trade down into bear territory. That's also coincidentally when Novo Nordisk really starts to trade up. They've both been on a downtrend the last month or so, 2 months, and that's attributable to several things. These pharmaceutical companies are also getting impacted by the RFK Jr. appointment news because he's honed in on pharmaceutical companies as a target as well. So that does ameliorate somewhat of the negative correlation or low correlation between the assets, but I still believe that this is a good risk parity trade. Another one would be Eli Lilly and Co., which is the American GLP-1 manufacturer. They have the Mounjaro drug, which it's been found to have more uses than just the weight loss element. But we're seeing Eli Lilly is trading at a PEG ratio below 1. So stratospheric price earnings ratio, but growing rapidly, at least over the last 12 months. And if we look at that, I would expect it to have a lockstep correlation with Novo Nordisk. In fact, yes, it looks like it has a very close correlation with Novo Nordisk, but a much higher beta, and has really outperformed. So I think that the entry price for both of these pharmaceutical makers right now is somewhat compelling as well because they have sold off in recent months. And if you were looking to enter into a significant position into Hershey, then do your own research, but it might make sense to establish positions in the opposing trade driven by sentiment as well. And so, is now a good time to purchase Hershey? Well, let's take a look at the chart here. So let's do some technical analysis. You see here, the stock was from the COVID lows, trading in a definite uptrend here. In July of last year, it broke through that support line and just sold all the way down, really, to this prior resistance level here. And throughout the majority of this year, had been really trading in what was somewhat of a bullish wedge up. And I'm not much of a technical analysis guy. I keep it pretty simple, but every time it bounced along this low 180s level, it recovered, made it up into the low 200s, and recovered down. Now, what we see here is that it has broken down below that level of support here. And in fact, it is now, it's at about $170 a share. It is now at this prior level of support from September 2021. It's conceivable to think that it might bounce off this level. If it were to break through, the next level looks to be 160, then 150. So the technical analysis of this chart is extremely weak. This stock looks very weak right now from a technical standpoint. If you have a long-term horizon, where it is right now is a good place to add, or really, I think all the way down to 150. I could see this stock trading all the way down to 160, maybe even 150, especially if the next few earnings reports continue to be stagnant with not good momentum in terms of revenue growth. So yeah, the grade for technical analysis is that this chart looks pretty bad. And again, if you have a long-term horizon, I would be considering adding here if it fits your portfolio strategy like it does mine. I think my cost basis is somewhere in the 180s, the low 180s, as I've added on these dips. But yeah, I would not expect this stock to start ripping up anytime soon until the earnings momentum demonstrates that. And so that's to coincide with that analysis. We see that the guidance that they provided, and this is their most recent earnings report from a few weeks ago, they guided down in terms of their prior guidance was that they were going to grow, revenue by 2%. They've guided down to flat, and they were guiding to 1 to 3% negative earnings per share growth. That has now gone to 6 to 9%. So they're definitely guiding for tough times ahead. So I think it's very fair to say, given the fundamentals of this stock being very weak, the chart being very weak, that it will continue to trade range bound within this 180 to 150 range, maybe all the way up to mid 200s. Their dividend policy is to pay out at least 50% free cash flow dividends, as well as grow their dividend. So the fact that they're guiding to no earnings growth, or losing earnings the next few quarters, or negative growth, I think it's conceivable to think that they will not raise the dividend with the upcoming dividend you see here. They just, I think today was the ex-dividend date. I think it's conceivable to think that the February dividend is also $1.37, or maybe they raise it 1 to 3 cents just to keep the dividend growth streak alive. But if you're looking at the growth that they've seen, dividends the last few years, and expecting there to be double-digit dividend growth to occur, I would be surprised if they raise the dividend significantly. However, that does not mean that this is not a compelling investment for the long term. I think it's somewhat of a mixed bag. There's a lot of mixed signals here. There's value, but there's certainly other stocks in the market right now that are growing very fast and seeing very positive momentum. And if you're looking to outperform in a short time frame, then it's probably best to keep this on your radar until it gets all the way down to a trading off of one of these base levels. And I lose my trend lines there. Okay, well, yeah, that has been the deep dive into Hershey stock. Hope you found this insightful. And just a reminder to like this video, subscribe to my channel, and hit the notification bell if you find this content interesting and want to see more of it, because there will be more of it. All right. Thank you. Until next time.